Paul Merriman says this investment mix beats the S&P 500 by a mile. I'm just looking over here because I want to make sure I'm giving it the right info from the headline. We're going to read this. Key word here, beats. Now, you're familiar with Paul Merriman, I'm sure. And I like Paul. I mean, I don't follow him all that much. I'm relatively new to learning about him the last few years, and he's okay. I got no qualm with him. He doesn't, I think he's fine. I got no issue. The issue, and I'm not even sure he had written this anyway, frankly. But again, hey, you. Oh, boy. Why start a video? Finny. Good boy. All right, good job. All right. The issue here is beats the S&P by a mile. And again, I don't know if he writes the headlines, but the idea that what it did and what it will do, it beat the past tense. Beats is a current and into the future tense. And we don't know that. Finny. Paul was ignoring him, and Finny wants to play. Come here, buddy. You want everybody to see Finny? Come here, buddy. Come here, Finn. Let's let everybody see old Finnegan. Come here, big boy. Come here. Everyone wants to see Finnegan. Who's look at this guy, everybody. Look at him. Oh my lands, look at that guy. He is his tail's wagging like crazy. You want to say hi to everybody? He's like 50 pounds now. He's getting big. He's a big boy. Oh, there's Pablo. Come on, buddy. Oh, okay. So for all you haters, I don't like the dogs. Well, guess what, man? I love them. They make me happy when skies are gray. All right, so Dateline, February 25th, 2021. The ultimate buy and hold portfolio for 2021. All right. The article is the core. This article is the core of my best advice for long-term investors. If you want the very best equity portfolio, you're about to learn what it is and how to put it together. Article has 3 parts. The first might be called an executive summary of key points. The second outlines a step-by-step process. And the third digs deeper into a few related topics. This is one of a series of articles I've written and updated annually for many years. Together, they outline a lifetime of wealth accumulation. What are you doing over there, big boy? They outline a lifetime of wealth accumulation strategy for do-it-yourself investors. Keyword, accumulation. Most of us are not in accumulation anymore. At least most of you guys are watching this channel. Please remember the 2 things. Accumulation, growing wealth, versus decumulation, safely reducing it so you can live without having to earn an income. Accumulation is what old Paul's talking about here. Now, I don't think a lot of people make the distinction well enough. Part 1. Ultimate isn't a term to toss around lightly. But in this case of ultimate buy and hold strategy, it fits. I believe this is the absolute best way for most investors to achieve long-term growth in the stock. The strategy is based on the best academic research I could find and the basis of my own investments. Let's see. Most investors rely almost exclusively on the S&P 500, but by adding equal portions of 9 other equity asset classes, long-term investors can double or even triple their returns. I freaking hate that stuff. Not gonna lie, I hate the idea that they can do this, they can do that. It's just based on past, man. We have no idea. It's just this based on academic studies. There's no academics into the emotional aspect of investing. It's just the whole thing is nuts. And look, I'm not trying to bash the guy, but I'm just saying, come on. The idea that this, and guess what? Buying Tesla stock could give me triple or quadruple returns of Bitcoin too. I mean, this you just don't know. I'm not saying it's bad advice, but I'm sitting there thinking the idea that I could get double or even triple my returns because of past endeavors, it's pure fanciful, man. We don't know that. And based on academic research makes it sound like it's scientific. The additional return comes primarily from taking advantage of long-term favorable returns of value stocks and small-cap stocks. Taking this step involves only minimum additional risk. No, okay, why are these stocks value? Because they're inherently riskier, man. That's why they're value. They trade at lower PE ratios, which means their price is lower than their earnings relative to growth stocks. Why? Something has happened to make them of value or value stocks. Lower PE, lower price to book, higher dividend yield. Remember, dividend yield is just a reflection of the price relative to the dividend it actually pays. So a higher dividend yield inherently means what? A lower price. The reason things are lower is because there's more risk. There's more downside potentially than upside. It just happens to be if they survive, they've shown to have more upside because once they get knocked down a lot, if you continue to buy them, you generally will outperform. You're generally going to outperform if you buy a lower price to earnings ratio stock than bond, than a higher PE ratio bond historically. But that's nonsensical to say they're lower risk. No. Or it only gives additional minimal risk. The ultimate buy and hold portfolio works best for investors who don't want to try to predict the future, time the market swings, or pick individual stocks. All right. Let's see. The ultimate all equity portfolio automatically takes advantage of stock market opportunities, but to help you, here's a table. So I want to show you this table. And again, I know it sounds like a bash. I get so perplexed by some of the stuff that's out there, even by well-known guys like Paul here. I don't. Can I not make it bigger without going one full thing? Maybe we can do it like this. Oh, there we go. Sweet. All right. So 1970 to 2020. That's the course of my life. That's it. That's 50-year experience. Just come on. It's 15 years. All right. So we got S&P 500, U.S. large cap value, U.S. small cap blend, U.S. small cap value. So he's overweighting value because value has done better over a certain time frame. And again, from basically 1976 to 1983, I think it was in value earned its keep and forever will go down in history as outperforming growth. So he's got small cap value, large cap value, S&P, which has some growth, small cap blend, which has growth in there too. So he's just value tilted, man. He's got REITs, international, emerging markets. So he's doing monthly rebalancing. It's nuts to do monthly rebalancing. Don't do that. And so here we got what he starts with. How much he starts? $100,000 or something like that. I don't know. What does he start with? I'm going to say $100,000. All right. So he's got ultimate buy and hold equity portfolio, 50% international and 50%. Is he really doing 50%? 50% international, 50% U.S. I don't think so. I think he's doing. I'm not sure what's going on here, so we'll have to look. Okay, right here. No, he's okay. He's 10. Okay, so he's got. This is basically Craig Israelson's thing here. We got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You got 10 positions with 10% each. Okay. 10% international, small. Yeah, I guess he is. Look at that. Yeah, he's got 50% international. I don't agree with that in the least, man. 50% international. International large cap blend, international large cap value. International small cap blend, international small cap value. Emerging markets. That's redundancy like you wouldn't believe. So he's definitely held heavy value. Standard deviation on the entirety is what? Does he give us a... He doesn't tell us a thing here. All right, I don't see... All right, anyway, so if we go to, what's he doing here, man? I can't tell. Is this just one, like 100,000 invest in the S&P 500 grew to 18 million? Is that what that's saying? 100,000 in small cap value grew to 24 million. 100,000 in emerging markets grew to 38 million. 100,000, there we go. Annualized compound return. So CAGR, compounded annual growth rate. 10.7 in S&P, 12.4 in emerging markets. Standard deviation of S&P is 16.9. Emerging markets is 18.5. Difference from portfolio one, which I guess is just the S&P 500, is $20 million. All right, well, I chuckle. All right, anyway, let's keep going. The next step involves shifting 10% of your portfolio from the S&P 500, which are regarded as relatively underpriced, to large cap value. Okay, the relatively underpriced has the term value. Okay, gotcha. So let's keep going. So basically, we just showed you what he did. So let's right here. He has these ETFs. I don't even know what AVUS is. I don't know what AVUV is. AV, I don't even know what that is. I don't have my phone. I don't really care. Unfortunately, this portfolio has a big drawback. It requires owning and periodically rebalancing 10 component parts. Relatively few investors have the time or inclination to do that. Since 1970, the light version of this buy and hold would have been produced virtually the same compounded return as the one outlined above. So he's got a new version, which okay. Fortunately, we have devised a 4-fund alternative that's much easier to implement. It won't surprise you that there's much more to say about this portfolio. In 2020, we recalculated results from the 1970s to reflect new data we did not have in previous years. We also changed our assumptions about fund expenses that investors would have been charged in the 1970s. We believe our recalculations will better reflect what the 21st century. Remember that song by the Doors, 21st century, was it 20th Century Fox? Can easily expect. All right, but even after these calculations, the return did not change materially. Okay, so I don't like. I mean, look, I don't care. Let's look at my man Craig. DuckDuckGo and hit the 712 portfolio. Did I just see somewhere that says 712 scams? I like the song, Craig. It is real, son. It is real, son. 712 scam. What the hell? Why would anyone say that's a scam? Too much. Let's see what this guy says. Portfolio Einstein. Great. Too much diversification. Okay, whatever. So I love Craig Israelson. I interviewed him many moons ago. Just a great guy. Good Christian man, by the way. And I can know the problem with all these portfolios is actually implementation. The idea you're going to rebalance on any given strategy, it's just not going to. How are you going to do that, man? I mean, my goodness. So some people are into this stuff. They like to spend the time to rebalance. I would rather take my head in an anvil, all right, and just have it go, not an anvil, a vice, and just have it close on me while some freaking starving monkeys are jumping around and picking at my brains than have to do this on a regular basis. But some people enjoy it, not me, man. I'd rather listen to those dogs do that while I'm trying to sleep than have to do this. It's just I can't. But anyway, some people like this. But anyway, issue being is Craig's stuff I like better than Paul's stuff because Craig's stuff. Can you hear those guys? Craig's stuff is not as all stocks. You can see. Just get a 712. I'll put a link to the show notes. There's a PDF on it, a bunch of PDFs, but you can see read the slide presentation. Let's see if this allows us to do this slideshow. It's got bonds, it's got cash, it's got gold. There we go. Right here. So we got tips. Don't say clean energy. No, Craig, no. Bonds, non-U.S. bonds. So he's got cash, non-U.S. bonds, U.S. bonds, tips. So it's definitely not all stocks like Paul's is. And as such, it gives you the downside risk mitigation that Paul says. Look, I'm not here against Paul. I guess I'm not trying to sound like I'm bashing the guy. What I'm trying to say at the end of the idea, we have 50-year track record. That doesn't mean anything, man. I'm sorry, it doesn't. The first 15 of those were heavy inflation, low stock returns. The value stocks did great back then. They did. I think it was. Let me find my book. Hold on a second. Here's Jeremy Siegel's Stocks for the Long Run, and I got 2 or 3. This is the 5th edition. This is after the GFC, the global financial crisis. And this is the Bible. I hate to say the Bible, but the Bible for a historical reference to stocks, for sure. Look, and again, the long run never arrives, and I always take issue with that too. But I'm a big fan of Jeremy Siegel. Love his work. Good time. So we're going to look at small cap value. Let's see. I need my freaking reading glasses if I can find it. All right, I'm going to pause it. Hold on a second. From page 176 of this, small and large cap stocks. All right, cracks in the capital asset pricing models' predictions of its stock returns appeared well before the French and Fama research. In 1981, Rolf Banz, a graduate student at the University of Chicago, investigated the returns on stocks using the database that had been recently compiled by the Center for Research and Security Prices, CRSP. He found that small stocks systematically outperform large stocks even after adjusting for risk as defined within the framework of the CAPM, the Capital Asset Pricing Model. To analyze this claim, the returns from 1926 through 2012 on 10 groups of more than 4,000 stocks sorted by market cap are shown in Table 12.2. The compound annual return of the smallest decile of stocks was 17.03% a year. So from 1926 to 2012, the compounded annual return of the smallest was 17.03 a year. That's the geometric return, by the way, not the arithmetic. All right. However, the total market was 9.67. Interesting. The largest 10% was 9.28. So by far and away, in fact, nothing even got above 13%. So the smallest of the small did the best. Not even close. Nothing comes close. All right. However, although historical returns on small stocks has outpaced large stocks since 1926, the magnitude of the small cap outperformance has waxed and waned unpredictably over the last 86 years. A comparison of the cumulative return, small stocks measured by the bottom quintile of market capitalization has even by the but between 1975 and 1983, small stocks exploded. Oh, that's what I was going to say. Small stocks recovered smartly from their beating during the Great Depression, but their performance only matched that of large stocks from 1926 to 1960. Even by the end of 1974, the average annual compounded return on small stocks exceeded large by only 0.5%. Not nearly enough to compensate most investors for the additional risk and trading cost. But between 1975 and 1983, small caps exploded. During these years, small stocks averaged 35.3%, compared with almost 15.7% on large stocks, almost doubling from that time, from 75 to 83. Small stocks doubled that of large stocks. All right? Cumulative returns of small stocks during those 9 years exceeded 1,400%. Nevertheless, this figure shows that the 9-year period from 1975 to 1983 is eliminated. The total accumulation in large stocks and small stocks from 1926 through 2006 is virtually the same. So again, and you need to get yourself a copy of it. I'm not even sure if this is most recent edition. This is 2011, I believe. I'll put a link in the show notes, and if you buy it and get the hard copy, I mean, it's a bit, it's a Bible, man, Bible for a stock investing. I'm a big fan, long time. If you get yourself a copy, buy it from my link so I can get that sweet, sweet Amazon money. But that kind of defeats the point about small caps having the French famine model. There used to be a 3-factor model. Small cap value is one of the factors. Because of what Siegel just pointed out, we had a 7, 8, 9 year time frame that they exploded. And those values, we don't have a 3-factor model anymore. Now it's like a 7-factor model. We keep adding to it because what worked in the past doesn't necessarily work in the future, which is my whole point with this Merriman thing. It's like, well, yes, it might have worked in the 50 years, but that's not nearly enough time to say it beats in the future. All right. Hope this makes sense. This went a lot longer than I anticipated, but I'd love to hear your thoughts. Thanks now.